Gold is approaching a massive liquidity zone right now, and smart money is absolutely preparing their next explosive move. Forget all the noise out there. My primary focus for today's explainer is a high-probability sell setup sitting right above key liquidity. But there is one absolute condition that literally must happen first before we even think about pulling the trigger. Okay, let's break this down right away. Institutions are actively laying a trap, and look, if you don't know what to look for, you're gonna be the one getting swept. I'm gonna show you exactly where smart money is positioned, the specific macro catalyst driving this whole thing, and the exact trigger we need to execute. Once you understand how these algorithms are engineered to hunt retail stop losses, you stop guessing and you start anticipating. So here's the magic number, $3965. This right here is the primary macro sell-side liquidity target where the big institutions are aiming. Most retail traders, they're looking at completely the wrong levels right now, trying to pick a bottom or catch a falling knife based on some random support lines drawn in the sand. But listen, the algorithms do not care about retail patterns. They are drawing price like a giant magnet straight down to this specific historical pool of liquidity. That pool is packed with thousands of vulnerable stop losses, and institutions desperately need that exact liquidity to exit their short positions and profit. All right, here is your immediate trading plan for today. Our daily and 4-hour macro bias remains heavily bearish. The primary setup we're hunting is a 15-minute short distribution, and our expected target is that completely unmitigated sell-side liquidity resting right beneath 3965. But you know, context is everything. Our hard invalidation level, meaning where this entire bearish thesis just completely falls apart, is a clean hourly close above 4026. If price closes above that, the whole institutional narrative shifts, and we just step aside. Now, looking at the hourly pricing, we're heavily pushed into deep discount arrays. Normally, your traditional indicators are screaming oversold here, right? And retail logic tells you it's time to buy. Traders see this severe drop, they naturally assume a bounce has to happen, and they step in to buy the dip. But here's the thing, the overarching institutional draw on liquidity remains firmly fixed on that 3965 downside target. They just aren't done selling yet. The algorithm is simply resting, accumulating new retail buy-side liquidity before making that next brutal leg down. When we zoom out to the daily and 4-hour timeframes, the reason for this target becomes super obvious. We're looking at a relentless institutional sell program. Just look at that aggressive displacement downwards. We've got continuous lower highs and lower lows, smashing right past previous structural supports with massive volume. Sellers are in complete control of the footprint here, leaving absolutely zero room for significant premium rebalances so far. Every single minor push-up is immediately met with huge institutional sell orders, destroying any hope for a macro reversal. But what's the actual fundamental engine driving this whole technical setup? Well, the macro narrative backing this is huge. We've seen significant diplomatic progress between the US and Iran, leading to the reopening of the Strait of Hormuz. Almost overnight, 20 million barrels of oil were released into the market, which dropped WTI crude prices down near $69 a barrel. That sharp drop in energy costs instantly cools down global inflation fears, which, you guessed it, reduces the pressure on the Fed for aggressive rate hikes. Because gold is traditionally a hedge against inflation, this cooling effect completely strips away its fundamental appeal. And that is exactly what the algorithms are pricing in. However, the market is sending us a massive warning signal for 7:30 p.m. tonight. We've got high-impact US Core PCE price index and GDP data dropping. And smart money absolutely relies on these exact events. Why? Because these institutions simply can't move their massive positions in quiet markets without causing major slippage. This high-impact news is going to act as the precise volatility catalyst needed to engineer the required liquidity sweep for our entry. The news isn't the reason for the move, it's simply the excuse they use to inject the volume required to spring the trap. So the most crucial part here is execution. Do not touch this right now. Instead, you wait for that 7:30 p.m. news release to inject some serious volatility. We want to see that volatility cause a sharp premium retracement upward, right into the 3998-4005 area, deliberately sweeping out the buy-side liquidity before violently displacing back down. This specific sequence is everything. If you jump in early, you become the liquidity. By waiting for the premium retracement, we align ourselves with the institutions who are looking to sell at a much higher, more advantageous price. Let's move over to the 15-minute time frame and see how this actually builds. Right now, a true institutional sweep into this specific fair value gap area hasn't matured yet. That gap represents an inefficiency in price, a real void that the algorithms inherently want to fill to balance the books, meaning smart money confirmation has not yet appeared. We are waiting patiently for the news to push price up into that gap, grab those buy stops resting just above the recent highs, and then violently shift market structure straight to the downside. When that displacement finally happens, here is your fully executable trade plan. You're looking to enter short between $39.98 and $4,005. Place a tight stop loss at $40.1250 to invalidate the idea if we're wrong. You take your first partial profit at $39.80 to secure capital and immediately move your stop to break even, getting all risk off the table. This is absolutely critical for your trading psychology. Take profit 2 is at $39.68, capturing the bulk of the move, and the final macro target sits at $39.60. This meticulous setup gives us a massive 1 to 3.5 risk to reward ratio. But here's the problem, and this is exactly where most traders are going to get completely trapped by the algorithm today. See, retail breakout sellers are looking at this heavy downward momentum right now, and they're trying to sell the absolute bottom. They feel the FOMO, they chase those big red candles, and they are going to get completely liquidated by that engineered pre-news upward retracement we just talked about. Meanwhile, smart money, they're just sitting on their hands, patiently waiting at that 4,000 premium level to create the trap, absorb that frantic retail liquidity as traders panic buy the spike, and then quietly distribute their massive short positions right into the hands of the unsuspecting public. So, to quickly recap this explainer, we are strictly bearish, playing for a continuation. But we absolutely must wait for that news-driven liquidity sweep into premium pricing. Our target objective remains that $39.65 macro sell-side liquidity pool. And please remember your risk management here. We are risking a maximum of 0.5% on this execution because of the extreme volatility we're expecting around the fundamental news drop. You survive in this game through capital preservation, guys, not by going all in on a single setup. If you enjoy this kind of institutional-style market analysis using ICT and smart money concepts, be sure to subscribe to ICT Market Theory. And if you'd like to trade alongside these setups, you can find the FXTM account link in the pinned comment below. Stay disciplined today. Wait for the algorithm to show its hand and manage your risk. The market is about to spring a trap. The only question is, are you going to be the one laying it or the one caught inside?